Everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. This will be hopefully a brief video. I won't be able to make a weekly open, the week ahead video on Sunday. It's going to be a couple of busy days over the weekend. So this is kind of where my thoughts really on the week ahead. Mainly the Nonfarm Payroll report on Friday. So just to give some broad context here, everything we've read, be it the consumer surveys, regional surveys, is probably best summarized by this purple, what you see highlighted in purple right here. Sentiment was buoyed in part by reduced trade worries following the pause on additional tariffs and the accompanying improved economic growth prospects. Again, why is that? Well, put it mildly, we go from 150% tariffs on China, practically a trade embargo, decoupling, to something that is more manageable, 30% tariffs on China. Now, again, I'll stress it again, 30% tariffs on China on its own isn't good. It's bad, very bad, okay? It's a lot higher than where we were before April 2nd, right? On its own, it's bad news. But is it as bad as 150% tariffs on China? No. So everybody can breathe at a sigh of relief, all right? And this has been the overarching theme for all the surveys, whether it be it on business or consumer. As far as some of the data is concerned, initial jobless claims have been somewhat elevated. The last print came in at 240. Again, just for context, the way I treat initial jobless claims is that anything below 215, you can generally expect the unemployment rate to move down. Anywhere between 215 and 220, you can expect the unemployment rate to be flat. Anything above 220, expect the unemployment rate to move up. And this is what we've seen. Initial jobless claims stay around 240, 230, 230, 226, and 240. Okay. We also saw this week the breakout on continuing claims. All right. Continuing claims move up. What does that tell us? It tells us that it's getting harder and harder, increasingly harder to find a job. And again, the way something I always mention, I make sure to mention when talking about jobless claims, is that if you look at initial jobless claims to say that everything is fine and dandy because we have low layoffs, in my opinion, you're missing a part of the picture, because recessions occur in two phases. Phase one is a low hire and low fire environment. Precisely what we have right now. Hirings have basically gone back to where they were in November 2015, and ironically, in 2007. The second part, the final part, is when we get the low hire and high firing environment, where you see initial jobless claims tick up. Everybody associates recessions with loss of jobs, job losses. That is the final part of the recession. And if you're waiting for initial jobless claims to peak to say that we're in a recession, well, you're closer to the end of the recession at that point than the beginning of one. So keep that in mind, all right? So initial jobless claims continuing their slow grind up, continuing claims breaking out. Next week, we have another read on ISM, PMIs for both manufacturing on Monday and services on Wednesday, if I'm not mistaken. Yes, right here. We also get another JOLTS report. We get the level of job openings. If the one way you could potentially take the job openings is, again, in relation to the level of continuing claims. Why? Well, if job openings continue to decline, it just means there are fewer and fewer opportunities to find a job if you lose one, meaning it gets harder and harder to find a new job. Hence, declining job openings just could add a little bit more fuel to continuing claims to move up. Just some food for thought there. Pay attention also to the quits rate. That's one of my favorites. I definitely haven't spoken about the quits rate in quite a while, but I still love you. Okay. Um, we get ADP as a first hint of what we could get on Friday, but again, try not to read too much into this number because again, it has very low correlation with what we see on Friday. Another read on continuing claims and initial jobless claims on Thursday, and finally, really, who am I kidding? The main event. All right, non-farm payrolls and the unemployment rate on Friday. Now, a week prior, I give my forecasts for both data points. So far, I've gotten the unemployment rate right. Right, if I'm not mistaken, my all my forecasts on the unemployment rate have been correct. I've been a little bit more iffy on the non-farm payrolls number, but that's very hard to forecast from just looking at PMIs. But regardless, I will give you my forecast, right? And I'll start from the PMIs. And why do I start from the PMIs? Because again, I just take the general vibe of the PMIs with major emphasis on the employment paragraphs and come up with a forecast, right? I just come up with a number and let's see, and I see how it lands. Again, what do we see throughout the report? Again, I made a video on that before. Overall, nothing new. We continue to see, depressed outlooks, albeit boosted, at least momentarily, by reduced trade worries. But again, the vibe has definitely not changed ever since February, with the added bonus, if you will, that employment in May, as far as the PMIs are concerned, fell slightly, both in manufacturing and service sector. All right. So my last forecast was for 80K on non-farm payrolls for April. And all I'll say is that you should watch for revisions. All right, we already got January and February trimmed by quite a bit. Look for negative revisions on April and March. Perhaps my 75K call won't look as ridiculous as it potentially did on last month, or rather earlier this month. So keep that in mind as well. Having said that, I'm fairly comfortable in the 80K region again, given everything that we've read in the surveys. I don't get a lot of strength really coming out of the PMIs. Again, I'm not expecting the smoking gun, as if you will, meaning negative payrolls, but I'm definitely not expecting anything. Let's say over 200K. That would definitely be a surprise to me. That would surprise me absolutely. So, non-farm payrolls, as far as I'm concerned, 80K. As far as the unemployment rate is concerned, I come back to what I said before. Anything below 220, right? You can expect the unemployment rate to stay flat, or in the case of being low of 215, you can expect the unemployment rate to move down. We've seen the exact opposite. We've seen initial jobless claims move up and actually stay elevated. We saw 240 and at the end of April, 229, 229, 226, and 240. All right. That to me tells me that, again, my base case is that we'll see a 0.1% rise on the unemployment rate. Currently, we set at 4.2. A 0.1% increase would put us at the July 2024 high on the unemployment rate. Now, I will leave some room for 4.4, but the only way we could see 4.4, a 2% increase on the unemployment rate, is if we see labor force participation shenanigans. If it goes up, because of, again, the pool of available labor goes up, that could mechanically, if you will, push the unemployment rate up. But again, my base case is that we see 4.3 on the unemployment rate. All right, that's my forecast. All right, right here. This is my forecast. I also see, I'll give you a couple of scenarios that could occur as far as TLT is concerned. Because again, that's what we're all here for. Sweet TLT. If we see non-farm payrolls in between 120 and 140 and the unemployment rate at 4.4, I could that would be your stagflationary, trade, if you will, where again bonds get clobbered because we have the stag coming in, with 4.4 on the unemployment rate, and the inflation coming in with an okay economy holding in there, which is potentially more prone to inflation, right? That's one outcome potentially. Run it hot, basically a beat across the board. Non-farm payrolls come in well above 165k, and the unemployment rate comes in at 4.2 or lower. That would be bad for bonds, because it's good for the economy. So, enough said. Third case is the bear case, and this is something that I'm personally leaning towards. Anywhere anything at or below 100k, and the unemployment rate ticking up. By a tenth or more. I definitely stand in the third case. We'll see how things evolve. Now, how could TLT react to these three scenarios? Well, scenario 1 and 2 are both bearish bonds, all right? And they would actually warrant a sweep of the previous low in 2023. All right. If we see any indication or continuation in the narrative of stagflation, or if we see that the economy is just better even than the PMIs are telling us and all the surveys are telling us, expect a sweep of the previous low, meaning the low that we put in October of 2023. Now, again, I personally have been operating under the assumption that eventually we will sweep the previous low. Again, that is in direct contrast to my forecast. But again, I'm just kind of readying myself to the possibility that we sweep the low, and that is why I always keep something on the side, because I might be wrong. Right? You never know what kind of a curveball the market might throw to you, and you always have to be ready. So, does this have to occur? Absolutely no. But if it does, I'm good. All right? That's basically the moral of the story. If, on the other hand, we have scenario 3, we would have to start paying a lot more credit to this low right here, to last week's low, really, if you will, or rather the week of May 19th. This could still be a higher low. This could still be something consistent with the 2010, 2011 outcome, where we put a slightly higher low compared to the previous one. Also, I'll give you something else to think about. I've probably mentioned it before, but another way you could potentially look at this entire move that started in September is through 5 waves. Right, wave number 1, number 2, 3, 4, and 5. Now, again, if we have case number 3, this would be the end of it. All right, when wave number 5 completed right here, and it completed with potentially the bearish bullish divergence on the RSI right here, when comparing the RSI from January 6th to the May 19th reading. Again, you have lower price action, but a higher RSI read, right? There's a lot that potentially is playing into this. Something else I'll give you to think about: oil. Oil seems to be, putting in, a classic bear flag, if you ask me. If the non-farm payroll report comes in weak, I think that puts $53 at the very least on the table. That wouldn't surprise me at all. And if it doesn't play out as a bear flag, it just means that, the non-farm payroll report came in quite good. So I'll leave it at that. Just to summarize, I think that June will tell us a lot of, what lies ahead for TLT. And the crossroads, if you will be next Friday. If we have, some follow through on all the bearish, analysis, if you will, of the economy via the hard data, putting in some weak numbers, then you can make the case that, these 5 waves have completed. You can make the case that this is the low that we've been looking for, as Obi-Wan would put it, meaning that, we put a slightly higher low, and we don't have to sweep, right? No sweep. This is the low we're looking for. And we can actually perhaps even look to breaking out on TLT out of this falling wedge right here. If, on the other hand, we have more homework to do, meaning that, we have scenario 1 or 2, look for this wave to complete somewhere around, the $80 mark. Okay. I'll leave it at that. My personal forecast, again, is right here. 80K and 4.3 on the unemployment rate. Let's see what next week brings us. If you like this kind of content, consider leaving a like and subscribing, and I'll see you next time. Bye.